Well, good afternoon, and that is what it is. It's good afternoon and noon today. It's Friday, the 24th of February, budget week, director resignation week, rand falling to 18 rand 50 to the US dollar week, and maybe a lot worse to come. My goodness, Justin Clark, Emma Swart, from our business partners at OrbVest. Before we go into the latest offering, and I know there are a lot of business community members who've been just dying to see what next you can deliver. It's taken you a little while to find something that met your value criteria. What are you making of the chaos that's happening in our country at the moment, Justin?
Alec, yeah, very disconcerting. I think that although we do rely on bad news, because people are obviously looking to invest offshore and make sure that they've got a plan B in terms of their capital. I think it's still very disconcerting for us South Africans to be in this predicament that we are in at the moment. But first of all, Alec, I just want to thank you for squeezing us into your chaotic week. I know you've got this really exciting Biz News number 5 conference coming up in the Berg, and we will be there and super looking forward to it. So thanks for that. And of course, on the back of all these things that are happening in Budget Week, I know you've been really, really busy trying to unpack all of that. So appreciate that, and thanks for all of those of you who are online now for joining us during this crazy week. Thanks a lot, Alec.
Thanks, Justin. I appreciate the sentiments, but I can tell you I really am living proof of Warren Buffett's adage that if you love what you do, you never work a day in your life. And this has been a phenomenal week for me. And the next week is going to be even better, because we have got an astonishingly good lineup at BNC 5, our first conference there. But we'll be seeing each other there for sure. I think I'm unfortunately not going to play golf this year because we've got a workshop on COVID-19. So Sue's going to have to go off there, your wife Sue, and go and win the competition on her own. But Emma, we're going to be with you in the Berg as well next week. You're I suppose we could say you're slightly younger than Justin and I. As someone in your generation, are people worried with what they're seeing about what's happening in South Africa?
Yes, I think there's a great concern about what's happening in South Africa, but the double-edged sword is, there's nowhere better in the world that we actually want to be living. We love South Africa, happy to be in South Africa, but it's just the concern around the future of the country and obviously our positions within the country. So you sort of, I almost want to say, are having a foot in both camps, where you still want to live and be here and your family lives and your connections and all of that here, but at the same time, maybe financially safeguarding ourselves by diversifying and getting some money offshore.
I've got a really good pal who lives pretty close by, and he says, put your money in a cold country and live in a warm one. I quite like that philosophy. But before we get into today's webinar, this is interactive, and our colleague Stuart Lohman looks after all the tech to make sure that everybody can hear us. Stu, do you want to just take us through how all of that works?
Excellent, thanks, Alec, and welcome, Justin and Emma. To those new to the webinars, there's a little control panel on the right-hand side of your screen. If you can hear my voice loud and clear, see Alec, Justin, and Emma on screen with a presentation underneath. Can you please give us a high five? There's a virtual high five on that control panel. Let me see, Alec, I've got some high fives. There we go, always good to see. And we do like to keep the webinars conversational. There is a question mark on that same control panel. If you can put your questions in there, Alec can pick them up as they go through the presentation. But all good on the technical side, Alec?
Magic, wonderful. Well, we have waited for quite a while, Justin, for your new or your latest opportunity to invest in US medical real estate. Perhaps before we go into it, how long has OrbVest been going for? And obviously this is, I think, your 42nd investment now. Why has it taken so long to get to number 42 after you, it appeared as though up to from 0 to 40 or 1 to 41 went at quite a clip?
No, absolutely, Alec. I think it's a very good way to start off. We've been sitting probably for 5 months without a new acquisition, a new building, and that's not for lack of looking, but we live off the delta between what we can buy these buildings at and what the debt will cost us to leverage that purchase. And of course, you have this very interesting scenario where there is excess capital coming out of the markets and looking for safe haven. And of course, they are looking at real estate, which is long-term investment. And in the real estate sector, where would you go? Would you go into office? There's a lot of concern over some of the commercial real estate categories. And suddenly the flavor of the day is healthcare. So you've got more money piling into healthcare, which means that the cap rates are remaining fairly constant. And of course, I've got a caveat to that as well. And interest rates have increased. So your cost of capital has gone up and your price of buildings has gone up at the same time. So it has made it pretty, not the right environment to be buying buildings. So we're searching for the needle in the haystack, and occasionally we find one. And we're super excited about the one we're going to present to you today.
And Emma, what happens from your perspective when your clients or investors in OrbVest are saying, where are you guys? 5 months, I've had to wait for another opportunity. How do you actually respond to those kind of questions?
I think we are very cautious when we are looking at the buildings. We're never going to buy a building for the sake of buying a building, because we do have investors waiting. We've got money waiting to go into our buildings, but we again have to be very careful, and the fundamentals have to be absolutely correct when we look at these buildings. So back to Justin's point, if we can't make the numbers work, we can't manipulate numbers to make them work. So it really is, we've got to wait until the right opportunity comes. Within OrbVest, we have got a short-term note that we opened, which allows investors to get money offshore if they feel it's the right time, sit that in an account earning interest at 5% on a shorter term basis. So there is kind of a stopgap, at least, where money can still go out the country, sit and wait for our next building. And subsequent to that, obviously, we can maybe touch on it a bit later. Again, that diversified holdings investment of ours, which is still open till the end of 2025, giving great returns. And currently, there is always something on our platform for investors to be investing in.
Stu, I've had a little, thanks to load shedding, a little technical issue. Can you just take over from here and just keep the conversation going while I go out and go back in?
Yes, I will do, Alec. I'm here. I'll do my best.
Be back in a moment. Good old load shedding. Apologies.
Justin, I'm going to try to take over the presentation. Let me just give me a sec. Or should we just talk through and wait for Alex to get back onto the presentation? Just look at sort of.
No, absolutely. I think just to follow on the conversation from where we were talking about the risk profile and us not acquiring buildings. I think, Alec, you're aware that we inherited some buildings that were very, very heavy lifting value add with the developer in the early days. And, we've learned some very hard lessons there. And that means that, in the environment that we're in, where people are really looking for, a safe investment, we are now driven towards these, what we call core and core plus assets. That means the thing is pretty much fully let. There's nothing that can go wrong, that you have a risk of losing your capital. And obviously there's always crazy things can happen in the world, but that drives us towards these core assets. So that makes us even more conservative. And if you look at the Medical 41, 100% let, long-term tenants, great competition for space in the area. And this one, 100% let, all medical also. So we're not touching buildings with office space. We're not touching buildings with a lot of vacancy. And we're even steering away from buildings that have the potential to get impacted by inflation, because that's another thing that is, that we've got to be very aware of. We have, for example, you in order to retain a property manager at the property, you're paying probably 30 to 40% more than 2 years ago. And that's not something that we ever would have assumed. So we like what we call these triple net buildings, which you can pass through a lot of these expenses, or actually all these expenses in the case of triple net, to the tenants. So it also reduces the number of buildings that we can look at that are suitable. We're not prepared to take any of the risks that we would have done in the past.
Right. Well, it looks like I've overcome the little issues, and let's get into our presentation. Justin, tell me when to move the slides. Here's your first one.
Right. So, Alec, as I said, we have one of our team members, Andrew Fotis, and again, apologies for not having any of the Americans on board. We do like to showcase some of the other smarter people in our team than us. But I think this graph is fairly interesting, and really it depicts what is happening with interest rates over time. And if you look at the bottom axis, it goes from May last year to current, and you will see the trends. And basically, I know that this is very hard to read on the slide, but if you look at the bottom blue, it's a sort of a light blue lowest hanging fruit there. You'll see that that's the 10-year Treasury interest rate. And you will notice that it is actually super low compared to the red, which is the short-term money cost of capital. So really translating this graph into sort of an understandable bite. Short-term money is still very expensive because there's a concern that interest rates will continue to go up as the Fed tries to get inflation under control. But in the medium to longer term, and all of those ones that are tracking the yellow, the blue, and then the other greeny blue one, that is the longer term money. And the interesting thing is, remember that we lock in our interest rates for 5 years, and that is the yellow line. And you can see the delta between the yellow line is kind of 1.3% between the 10-year money and 5-year money. So the market is effectively saying that interest rates are going to cap out in the next 2 years, and then they're going to start dropping off. And so this is very interesting, and obviously our team monitors this on a literally a daily basis, this graph, to see where interest rates are tracking. So yeah, 5-year money is considerably cheaper than short-term money, and it's interesting that it doesn't necessarily correlate with SOFR, which obviously is still tracking upwards. But interesting all the same to see that delta between short-term and long-term money in America.
Right, and here's number 42. Tell us about it. Where is it? Sugarloaf.
Wow, the needle we finally found. So, Alec, I think you can see from the picture here, guys, this is a very simple single-story building. And you'll actually see from the next slide, there's no common areas. There is no lifts, there's no escalators, and so it's a super simple building, not very complicated. And I think we need to talk a little bit about where it's situated. And if you remember on our first conversation, Alec, we said that our hypothesis was that if you're buying a building and you want to be sure that if you have a rollover and a tenant leaves, there are a number of tenants that can fill that space. The smaller the city, the less potential good doctors you can get that can come into the building. And so we always favored the gateway cities, and Atlanta is a fascinating city. And I know that a lot of sappers that travel to the US go to either the West Coast or the East Coast, or maybe a bit of Florida for a bit of beach time. But no one really travels to Atlanta and don't know a hell of a lot about Atlanta. First of all, that massive airport in Atlanta, if you've ever traveled through there, Alec, is still the busiest airport in the world. It is really the gateway to the US. If you're going there on business and you're traveling to anywhere in the Midwest or the South, you generally go through Atlanta as opposed to New York. And I'm glad to say that they're bringing back the direct flights from Cape Town and Joburg straight into Atlanta, which is great. But the city is still growing phenomenally fast. It is, I think, the 9th biggest MSA in the United States at the moment. It's home to a number of Fortune 500 companies. And there's this growth corridor that sort of runs up towards the north. And Duluth, where this particular building is there. And being a keen golfer, you will know exactly where it is because you would have watched many golf tournaments at Sugarloaf. And Sugarloaf is literally a few miles away from this building. So it is in this growth corridor, and Duluth is a very upmarket portion of the particular county. It is sandwiched, but it's right next to, with great access to the Interstate 85. It's just a super location. And anybody who knows anything about real estate will understand that location is very important. The other thing, there's this debate in the healthcare space, Alec, that do you want to be on campus, in other words, right next to the hospital, where the doctors are working together with the hospital, orthopedic surgeons, for example, that will consult outside of the hospital and then put their patients in. This is not a on-campus building, but there is a trend, and that's a whole other discussion, in this new world where we are looking for service. We don't want the blood and bandages of hospitals. We want service, and that's convenient to us in our suburb. And this meets that criteria 100%. So I think we probably talked enough about the location. Perhaps the other thing that's quite important to note is that although it's not on campus, one of the largest hospitals, the Northside Gwynneth Hospital System, which is, I think it mentions 388 beds, it's got about 5,000 healthcare workers, is only five odd miles away. So there is still quite a lot of synergy with the hospitals, and certainly anyone that has any form of a dental issue from the hospital, this is certainly one of the feeder buildings that would support those dental issues. So that's a little bit on the building, and I think the other major important points to talk about is that it is all 100% medical, it is all triple net leases, and all core medical. And again, simple building, no deferred maintenance. I think you're sick of hearing my voice. I'll let Emma have a step in here and talk a little bit to it. Perfect. Just to introduce to your audience, Emma is part of our one of the directors of OrbVest SA, and she is also the manager of, amongst her many tasks, of our investment committee. So she's very familiar with all the detail of this building. So no one better to talk to it than her.
Thanks, Justin. Yeah, something also to mention, this building is probably 10 miles away from our Atlanta office. So one that obviously our team in America has walked, has looked at, and knows the area very, very well. Another quite unique characteristic, I suppose, of this building is that of all the buildings in Duluth that have got any medical tenants, this is the only building that was specifically built for medical. So it really is, as you say, a gem that we have managed to find. You can see in that picture that it's a lovely L shape with all the tenants being able to easily refer patients, across to each other. Justin mentioned it again, that fee simple, meaning no escalators, no elevators, very little common areas. So just from a maintenance and an upkeep point of view, a very simple, easy building. Again, with the proximity to that hospital, although we are not on campus, we do like to be close to hospitals, again, from a referral point of view. If we go on to this next slide, really what we are showing here is that what we are purchasing the building for, and from a rental growth point of view. The weighted average rental, we are slightly above average here. We are purchasing at $23.45 per square foot, where the average in the fourth quarter was 22.8. But again, this is something we would expect for this superior type of building, all medical, 100% tenanted, so very happy with that. If we look again at what we are purchasing on the second part of that, the rate, the dollar per square foot from a purchase point of view, we are purchasing at 3.24, where the market average is 326. So again, very happy and in market related purchase price. You can just jump into the next slide. So a little bit about these tenants specifically in this building. Another great thing we love about this building is 7 tenants, and 6 of these tenants are all dental focused. What this means again is that there is great synergies between these dentists and all these tenants, and the dental work that they do kind of across the board, from maxillofacial services, periodontics, our standard Anderson & Anderson, who are family office, husband and wife, and a succession plan. Their son, Dr. Eric, has joined the practice. So again, just in terms of these tenants specifically, the building was built in 2006. Atlanta Oral and Facial Surgery have been in that building for 16 years. The Georgia Periodontics, they've been in the building for 13 years. Anderson and Anderson also since the building was built. So we can see that these tenants have been in this building for a very long time. One of the concerns, well, the only one that is not dental is the Georgia Obgyn Society. But again, they've been in this building for 7 years already. One of the concerns from an investment committee point of view is that the weighted average lease term at Volt is below our desired 5 years. You can see there it's at 4.74. However, when we looked at the tenants and the profile, you can see there on that second kind of graph, majority of these tenants have been in for 5, 10, 15, 16 years. And so obviously the lease profile of these buildings is that they continue to renew every 5 years. If you look at that grey section at the end there, it's showing, when those leases fall due, and we extend hopefully for, an additional 5 years or longer if we can, it just pushes out that lease profile. So we did manage to get comfortable around the fact that these tenants have been there for a very long time. And in this type of setup, it's very difficult for a tenant to leave because they have built up such good referral bases between each other. We have got another building, it was Medical 35, where it's almost a copy and paste of this one, where it was also a dentistry focused building. Again, one of the concerns was that 3 of those leases were coming up for renewal at the same time. And those 3 those businesses were in fact purchased by a consolidator in the States, which we've seen is a trend specifically in this dentistry space in the US. And despite that, all 3 of them continued to renew their leases. Again, just showing that these synergies, to stress, I suppose, the importance of this, that once they have been in this building, built up their client bases, it's very difficult for them to leave, or they'll be loath to leave to move on to another building.
Emma, when they, just as an aside, when they sell their businesses or perhaps decide to leave because they're retiring, do they get key money? I remember in South Africa, if you had a position in a retail, in a shopping center, and it was a really good position, even though your business might not be doing that well, you could sell that position to someone for key money. Do you get that kind of thing happening in the US and in particular in medical properties?
Do you want me to jump in there, Em? Because why I'm taking the question from Alec is that we've spent quite a lot of time trying to understand what they call DSOs, or dental service organizations. And effectively, it's venture capital that buys a leading brand, and then they just buy up all the practices that they can as fast as they can. And then they take over the administration, which is quite significant because of the complexity of dental insurance. The change is a trend, and this is a big trend globally, that how medical works is pay for service. As you know, you go into the doctor, you pay for your consultation, and you leave. And that is very expensive. Well, I won't get into the reasons for it, but I'm sure you're onto that already. And they're trying to get a fee per outcome whereby you can charge for a client on an ongoing basis, and it's up to the dentist to make sure that they service that client correctly. So there's a significant change which is leading to this massive consolidation that's happening. So to answer your question, what they generally do is they will buy the practice, but they will retain the doctor and hold back some of the money. They want the doctor to work out a period before the full payment for the practice is made. But generally, the decision about where they house the practice and if they move it somewhere else, that's the decision of the DSO.
It's just logical. If you've got a professional operation and people as looking at some of these from 2006, Anderson and Anderson, people in the district, in the area, in the catchment area, would know about Anderson and Anderson being there. For Anderson and Anderson now to maybe sell to Clark and Clark, Clark and Clark presumably is going to have to pay something for that, because you would get quite a lot of walk-in business. They know, go off to your dentist, that's where they are. And that was all that I was trying to explore there. But I guess it's one of those things that you can sometimes dig a little too deeply into the detail. But I think you make the point there very well, Emma, that 3 of the 7 tenants have actually been in the building since it started in 2006. So a lot of their value would have been built in the fact that they're there, that they actually live in that area.
Yes, absolutely. And their reluctance to leave it, because when they leave that, it's exactly that. Everyone that knows them in that area would lose that the 16 years of building up their client base.
It's so interesting, and I guess that's what also makes these, or the reason why you focused in this area on medical properties. Okay, here's the number crunching. Take us through this, please.
Perfect. So just to run through this quickly, this building we purchased at $7.65 million, which is a 3-4% cap rate. We haven't seen something above a 7% cap for a very, very long time. Again, your question earlier around us not being able to have found a building or brought one, to the market, to our investors, was not because of the lack of buildings, but we were looking at buildings at 5.5% cap. Which then again, the numbers we just can't get those numbers to work. When we look at this, put this project capital structure together, it's really just to cover every single cost that we have spent, will spend, or foresee spending within this 5-year hold of the building. So, for example, there is a lot of due diligence that's done. We get a property assessment report where we then look into things that are expensive, a roof structure. Is the roof going to need to be replaced or repaired? You'd look at the HVAC system. Is it a centralized HVAC system? Is it separate? Again, in this building, we like it. There's no centralized massive HVAC system. So if something happens, you could go and individually replace or repair the HVAC systems on them. So there's a lot of work that is done, again, from a due diligence point of view. Banks fees, closing fees, interest reserve, etc. That's covered in that first section. Again, another thing with regards to just a slight change, along with increasing interest rates, we found that the banks that were generally lending around a 65 to 70% loan to value, they're also being a bit more conservative, and the loan to values have dropped to closer to a 55, 60% loan to value. So you'll see on this one, we are just below a 60% loan to value from a loan point of view. A bank requirement would be to have a debt service cover ratio of 1.25 times, where on this building we are 1.78. We always aim to try and be closer to a 2 times debt service cover, meaning that almost 50% of your tenants in a building don't pay their rentals, and we are still in a position to be able to cover our debt. Again, another thing, we have moved just from a business away from having sponsors or partners on a building, where we like to be our own sponsor, partner, GP on a building. So again, you'll see the split on that is, your investors, when we look at exiting this building, get 80% of the upside, and OrbVest that 20%.
Right.
The amount of capital we can raise is at $3.257 million. So we do have a fair amount of equity available, of which $1 million of that we will allocate to our diversified portfolio. So those investors that have gone into that spread of 26 of our buildings will get the benefit of this property as well, by us allocating a portion of this to ODH, which means from an investment point of view, on individual investors, we're only looking at around a $2.2 million raise here.
I see that you put the minimum at $5,000. Now, I remember that we had a Christmas special at $1,000. Is it just not possible to do that at that level?
Like we generally the cost of onboarding a client is more than $1,000, but for business, I think I can quite happily say that we will reduce it to $1,000, but that's really just only for our tribe.
Fantastic, thank you. I'm sure there are people who would like to go into ODH because of the diversified, but then maybe this being a dental building, they might say, this is one I really like. perhaps $1,000. It's very kind of you to say that. Thank you, Justin. Okay, on to our next slide.
So this is, again, what everyone likes to see, what the returns on this building are going to be. So first section, if you're a US accredited investor or have LLCs, etc., set up, that would be you. But for the rest of us, as South Africans and the other 30 countries we raise funds from, that would be the international investor returns. So we're looking again from year one of around a 7% cash on cash, which is paid quarterly, again in the form of dividends, and then escalating year 2, 3, 4 to year 5 up to 9.2%, with an internal rate of return between that 10 and 11% range. I think a question will be, how are we jumping from 7 to 9.2 from year 1 to year 5, which seems to be tracking up quite a lot quicker than the normal escalations of a rental from a return point of view. And the reason is we have made some assumptions with regards to the loan period and the interest rates on this building specifically. So what we've done on this one, we have been engaging and dealing with the bank on quite a few transactions now, South Bank, and the deal team in the States have managed to secure us a 5-year fixed rate of 6.25% for our funding, but with the option within any period, initially it was 2 years, sorry, but that's changed, where we are able to, if we see the interest rates coming down, we are able to break that fix with no penalty, which is a very unusual to us in South Africa. You fix a rate and you lose all flexibility around that. You pay your breakage costs, your early, interest fees, etc., and all of that. So we, from a benefit point of view, as Justin said earlier, we do expect the interest rates to start tracking downwards. And again, that first graph Justin showed you speaks to that. And therefore, we have said within year 3, we would look at refinancing that property. Ideally, we think we will get cheaper money for that. And that those returns then reflect that refinancing. If we do not get to refinance it and the interest rates aren't doing what we anticipate them to do, then we are in a no worse position because we've got our fix, which is a guaranteed 5-year fix. We do have the opportunity to,
please carry on and finish, because we do have a question that I'm going to have to go back a couple of slides.
That's perfect. Yeah, all I was going to say is we do, obviously have an option within that period as well to relook at the way we do our funding, if we're going to do an interest-only repayment, which then again would increase the returns. So as we say, that really just explains why the 7 to the 9.2, that we have safeguarded against interest rate increases by fixing our rates.
Just to remind you that I only will use your first name, not your full name. So that really gives you complete anonymity when you do post your questions. This one's from Quibus. And he says, I note one tenant, and that means we go back to this graph here, Georgia OB Gin at $19.50, has had no CPI increase since 2015. Tenant stop is 12.25. Okay, I get that. That's when the end of the lease will expire. Will you be able to reset them to market-related rents at the end of 2025? It's a good question.
Okay, yeah, so do you want me to jump in here, Jess?
Absolutely.
Perfect. So they were a slightly different, on a slightly different lease to the other ones with the standard escalation. And a good question, because it came up yesterday, which made us go back and pull the lease and have a good look at it. So what they did was they initially signed a lease, and they've been in the building, I think, currently for 7 years. So they signed a lease, but then they almost caught up the escalations in year 5. So they were flat for 5 years, then would have a bigger escalation. So it was just over $2 per square foot, which then averaged out to be roughly a 2% increase on their lease. So again, they are in their second 5-year period, which is a flat rental. And then when we relook at negotiating that lease again, there will be a higher escalation of just over $3 per square foot, which will then bring them in line with market-related rentals.
Okay, well, that question well answered. Let's move back to the other graphs, and just to remind you that you do have the OrbVest Duo here to answer your difficult questions, so don't worry about how difficult they are. Emma, you want to pick up on this one?
Yeah, Jess, maybe everyone's tired of my voice now. You jump in here.
Okay, great. Sorry, Alec. I'll just summarize. This we don't want to keep everyone online for long. So, I think what we're super excited about in this asset, and I'm just going to sort of recap some of the stuff that Emma was talking about. First of all, I talked a lot in the beginning about the gateway city, this fantastic growth corridor, the proximity to Alec's favorite golf course, and the suburb of Duluth. And if you Google it, it's fantastic. It kind of reminds you of the old days of, a Disney type suburb where everyone's sitting on the lawn together with the orchestra playing music. It really is quite an awesome little upmarket suburb of Atlanta. Secondly, and this, let's not underestimate this, is the synergistic relationship between these dentists. They refer to each other. And I think this is something that we've learned is very important when trying to find a building. So dentists are generally also long-term tenants. Bear in mind, they've got quite a lot of fit-out expenses, and in the States, there's a lot of compliance around the water, HVAC, etc. The triple net leases.
What is HVAC? Sorry, Justin. HVAC.
Yeah, no, that's just the American sort of term for central air conditioning. I don't know what the abbreviation is, to be quite honest, Alec, but we just so used to thinking in terms of that. So HVAC is obviously one of the big costs always in these buildings, because you are talking about quite hot temperatures in the summer. And of course, you need heating in the winter. So these HVACs are quite sophisticated. Second, this other thing is that, as Emma mentioned, it's fee simple, which means there's no ground leases or anything complicated, which is another lesson that we learned from the early days. Fixed debt from South Bank at 6.25, which in today's terms you won't get again, because subsequent to them committing in a term sheet, they the rates have gone up. So that's actually a very good rate. And the great thing here is there's no defeasance, and that means that we can break the loan at any point if we can get cheaper money. And we're very, very confident that we'll get cheaper money in 2 to 3 years' time, based on what the data is telling us from the market. And then finally, it's just a very simple building with great cash flows, and it meets our return criteria, Alec. So that's a brief summary of the building.
And that's the end of the presentation part of the conversation. Well, we are available for questions. If you'd like to tap them in, just go onto the control panel. There's a question mark there. Click on that. Send through your questions. We'll only use your first name. And I guess if you've got anything to add to the questions that have come forward so far, but I suppose in many ways, Justin, our community is now really getting OrbVest and understanding what OrbVest is about, and that it's focused on medical properties and getting a lot more comfort. The issue, of course, for many South Africans is this 1850 to the US dollar, where the rand is at the moment. And people might be thinking, this is a very high level, a very weak rand. I should wait for the rand to appreciate before I make an investment into US properties. I'm sure you guys get these questions all the time from your clients and your investors. How do you answer that?
Well, I'll go first, Em. You answer this question more than I do nowadays. But, I think that, if you look at the trend of the rand over time, you look at our fundamentals in South Africa, and you look at the continued strength of the dollar, you kind of are never going to get this 100% right. So our idea is that you move a little bit of money and don't move it all in one shot, and you spread it over time, and you just close your eyes at the rate, because sometimes you'll score the rate, the rand will be relatively strong, and sometimes you won't. But interestingly, we talk about the returns of buildings over time, some of the older buildings, and some of those guys, we don't even take into consideration the fact that they move their money at 11 and 12 rand to the dollar. At the time, having the same question, isn't this too expensive to be moving our money at 11 Rand to the dollar? So I think that answers your question, Alec.
Johan asks a question here, which is, what is the time frame to deploy allocated funds?
So I think the question there is about closing. And normally how these things work is there is a period of due diligence, which we're already into. So let's say there's 2 weeks left of due diligence. And then effectively the deal goes hard. We still have one more investment committee meeting, which is, what's it, it's M40, is it?
Yeah.
M40, yeah. And then basically it's 60 days to close. If we have got all the funds in place, we would like to close quicker. But generally we say 60 days. So I would say, you're probably looking at 60, maybe 60 plus a week, if that answers the question.
And Candice's question, which is probably the last one that we have today, is what are OrbVest's capital reserves? What are the early withdrawal risks for investors?
So these are alternate investments. They're not they're fixed term investments for 5 years, but we have quite a few investors that for reasons, for personal reasons, need to cash in their investment. Remember that we actually use the Seychelles merge exchange, so it is effectively a tier 1 stock exchange, and you can actually put your shares up for sale there. Generally, we find that the price of the shares change hands at around about 95 cents on the dollar. The reason is there's a little bit of friction cost there. So if you want to sell early, it's not ideal, but you would have got the quarterly, cash on cash dividend over that period of time, and then you will be able to sell your shares at that price.
Okay, and the benefit, I guess, for someone. Oh, sorry, Alec. Yeah, I was going to say, you're often one obviously willing buyer, willing seller. You own shares in which are listed on merge, but generally, if you've got a building that you've been holding for 3 years and you're looking to exit it, for a new investor to come in and buy those shares and only have to hold them for 2 years to get the benefit of the capital gain of the building on exit, we internally have been able to facilitate investors that have, for whatever unforeseen circumstances, needed to sell their shares.
That makes a lot of sense. Kobus has got a follow-up question. If we invest today in this opportunity, what happens to the funds committed between today and closing? Will the funds be returned if you don't go ahead with this investment?
Yours, Emma.
Yeah, so we do. The funds, one of 2 options is what we can do is you would move your funds into your OrbVest wallet and you could place them into the note, so that from the day the funds arrive to the closing, they are earning that per month. It's per annum, it's a 5%, obviously prorated. If the investment doesn't go ahead, those funds are still actually sitting in your OrbVest wallet. They haven't actually left your realm or your world on the OrbVest platform yet. So those funds are still yours. You can transfer them back to wherever you'd like to, or they'd sit in the notes, waiting for the next project to come up.
Well, we've got to our 45 minutes for today's webinar. Justin and Emma, thank you very much for explaining all of this. I'm sure that those who have got further questions can get a hold of you. There's the www. The website address, orbvest.com. This webinar recording will also be on the Biz News TV channel, so it's there to go and refer back to. Until the next time, hopefully it's not another 5 months before you find your next investment for our community. I look forward to picking up with you at that point. Final words each, Justin?
Well, again, everybody, thanks for joining us online. Really appreciate it. I think, Stu, you've posted a link to, if you want to contact us, that would make it even easier. And Alec, thanks for squeezing us in this crazy week. We look forward to seeing you next week.
Emma?
Thank you very much, Alec. Yeah, this was wonderful and always nice to speak to your Biz News community or family. It's a wonderful reach, and thank you so much.
Indeed. Until the next time, I'm Alec Hogg. Cheerio.
you.